affordable homes in Greenville, North Carolina.
We're going to get to all of that and more and break it down by numbers. But before we get all to that, let's hit it. Hi, it's Alan Victoria. Welcome to our channel and podcast.
And if this is your first time in our podcast YouTube channel, make sure you subscribe and get notified.
Also, call, text, all the time at 252-327-3357. We love talking to you. Do not be shy. Also, don't forget to get our buyer's guide and seller's guide in the description below.
Exactly. And today we pretty much wanted to talk about the primary cost of buying a home here and break it down for you that is digestible. And stay tuned because we're going to unpack lots of material for you.
Okay, it's going to be about not a bunch of numbers. So you make $40,000, $70,000, $100,000 with a 7% interest rate, which is what it is at the filming of this video. Well, what kind of numbers are we talking about? What kind of debt are we looking at? So we're going to get into the numbers of home ownership. So number one thing is, of course, what is included with your mortgage?
Exactly. Basically, what is included is the principal that you borrow plus the interest that the bank or any finance institution, they're going to charge you. On top of that, you have the property tax and homeowner's insurance.
Right, so all of that is into your monthly payment. So your monthly payment is not your HOA, it's not your landscaping, but it is all of those things included. So it's one number that you pay monthly. And then you also have to think about like what kind of maintenance and home costs you're going to have about all of that in the future.
Exactly.
Now, let's talk about if you're saying, oh, I'm afraid I should just be renting. Let's talk about the renting.
Exactly. Here, basically, we wanted to talk about the renting perspective. And there is a rule that they call it what?
The
30% rule.
They say that you shouldn't be renting for more than 30% of your income. And yet, if we look at today's world and how much rents are across the nation and here in Greenville, we see that that is probably not true. People are paying more 50% on rent alone. So that's not really a hard and fast rule. It's not a realistic number, but it is the number that financial gurus love to tell us that we should be following, right?
Yes.
And I've lived many of my life not following the 30% rule. So I can't say, oh, we should always be doing that because I didn't do that myself. Now,
that's why we wanted to talk basically about the budget strategy to get to the basically in nitty gritty that what is the difference of the numbers and discuss that with this all that we talk about, if you get the loan, how it's going to affect everything.
Loan by mortgage, right? So now there are some mortgages that allow you to go up to 50% in debt. We did not keep that one here, but there are some loans like the VA loan, and some lenders will allow you to go up to 50%. Exactly. But the typical rule for most lenders and most loan products is going to be 43% of your debt, based on the number that you can afford.
Yeah, so this is very idealistic.
43?
Yeah, 43. I mean, it's very idealistic. If you meet that, it's golden.
Yeah,
you know?
That's why we put it as the golden rule of what we can afford right now.
But then before we jump to the next, I wanted to mention that most of the lenders, they're looking at your credit score. And also, if you have more assets, that's why they might go even more than 50% of the DTI.
Right, now debt. Now, your car is a debt. So if you spend $50,000 on a car or $100,000 because you got two cars, your debt is going to, unless you make $200,000 a year, even still your debt is high with that one.
Exactly.
So understand debt is all of your debts, your student loans, your car payments, that's the most common ones. Your credit cards can be all of that, that's all part of your debt.
Basically, your debt is two sections. We are not going to go in detail, but it's front end and back end. And each of them, the housing and the car payment, as my wife said, any basically personal loan, these are going to one of these two categories. And then is your gross income before the taxes.
Right. So now we want to kind of look at these numbers and say, if you're making $40,000 a year in Greenville, what would 30% be? What would 40% be? What would 43% be on a monthly payment?
Exactly.
And then we have the assumption of 7% with 7% interest rate with a 5% down payment, in which we're going to tell you what that would be. And we're going to give you a basic number of what kind of price you're looking for. This is not a hard and fast rule.
Exactly.
These are based on some numbers that we're assuming that you don't have any more debt, all of this fun stuff as well. So if you're looking at, if you make $40,000 a year and you want to keep your debt at 30%, which is of course the golden, you want to only
30%?
you want to have a payment of $812.70. However, if you do not have any assets, this is going to be a very unrealistic number that we can find for you.
Exactly.
That house doesn't really exist in this market at this moment with those interest rates of 7% because that's unrealistic. realistic. Like, it's not. It doesn't exist.
Why
I
is
can't make
30%? We said that is 43%.
40% is the next number. 40%.
Okay,
if you want to
40%.
keep your payments at 40% of your debt, that would be $1,083 a month, right? And then even still, that's a little bit more possible, but not still unrealistic. The 43%, we're kind of getting into something else. It's going to be $1,164 per month. Now with this, now we make assumptions. With $1,164 a month, 7% down, 5% down payment, which is going, and so we're looking at $162,000. That's going to need you're going to need to bring to the table $10,000. And you're going to have to assume the closing costs are between $4,000 to $7,000.
What price of a home they're looking?
$162,000.
And then how much is going to be their monthly payment?
$1,164.
Okay. And then for what else?
Now, I mean, just so you know on that one, if you're 40%. So I think now we're going to move on to the 70% number. So if you make $70,000 a year.
Okay.
Right, so it's $70,000 a year. Now we're talking a little bit higher numbers. These are a little bit more affordable. At 30%, you want to tell me what that is?
In 30%, basically you are 1339.2 a month, which
20
cents. That brings us a little bit more reasonable now for the monthly payment. And if we go one level higher, which is the 40%, then your monthly, the 40% is going to be $17.85.60 a month. And 43%, how much is going to be?
$19.52. Now, with this one, I have some good news for you here in Greenville. If you are looking at the highest end of 43%, you make $70,000 a year with a 7% interest rate and 5% down. You're looking at $258. And that's assuming you're going to bring $13,000 to closing and $4,000 to $7,000 for closing costs. For the down payment and the closing cost. $13,000 down payment, $4,000 to $7,000 for those closing costs.
And then how much the house they're going to get?
$258,000.
$258,000. This is for 7% interest rate.
Now, just to give you some comparable numbers, because we know of a home right now at the filming of this video where they're going to offer $288 at a 4.99% in Ayden, but that would bring your payment also to about $19.19 a month. But that's because that builder is offering the 4.99% interest rate on that house, and then they're offering free closing costs. So you would just have to show up with your down payment of about $13,000.
Exactly. Now we're going to go level up to go to the next income, which is $100,000 income. And here, the 30%, the DTI, you mean, is going to be $18.28.50. 40% is going to be $25.18, and 43, which is a starting of what the loan officer or lender they wanted, is going to be $26.20.85 a month with 7% interest rate and the property tax and everything that we were talking about.
And the down payment of 5%.
5% down. And basically, what you going to afford to buy?
$339,000 with $17,000 down and $4,000 to $7,000 in closing costs. Now, this also means that we are in new home territory, and new homes sometimes come with options, so which would bring down your closing costs or something like that. So I want to say that, if you're making $100,000, there is deals for you out there, including
exactly.
You're in new territory.
Now, going to the next thing that we wanted to talk is about the lender's perspective, no? Because each person really in the lending world is a different and unique situation.
And we're not going to get too much into the lender thing because we are not lenders. We're going to get into the homes, which is a little bit more. But basically, we understand that your debt credit score, your income, and your debt are the three things that affect home affordability, right? So we broke it down into income. However, there's more things to talk about here.
And the top two that is super important basically is your credit score and your debt to income ratio, or DTI, that you might heard a lot of times. And what we wanted to add here,
I want to talk about it as a real estate perspective, because we have these homes in Greenville. So if you're talking $40,000 and you're looking for $1,162 and $162,000, those are probably your older brick homes. We do have them. We're probably a little bit more in the country, or a little bit more inner city. Not necessarily things are always possible. Things do pop up. But understand, we are looking at older homes. At the $70,000, when we're talking about $258, these are actually what?
starter homes, basically.
Right. Starter homes are a little harder to find because a lot of people are staying in their starter homes longer. We do have them here in Pitt County, though, which I love.
And also sometimes with that luck, you can get even a brand new homes.
Like I talked about,
with
brand
a
new.
good interest rate. You can definitely do that with the $70,000. What about the $100,000?
$100,000, you are in whatever house you want territory, really. So we have a lot of homes over $300,000. It's just 339 is an easy number to get to. You can be in new, you can be in pre-owned, you can get into a lot of homes. But what's lovely is that we have this inventory here. A lot of places in the country will tell you they have no inventory, whatever. But here in the city of Greenville, in Eastern North Carolina, we have brand new, we have pre-existing, we have all of these things.
Exactly. What do you wanted to add more? Do you want to add anything more?
Yeah, I want to add the PMI will eventually go away as well. So say you're looking at 43% and that 5% down, like we told you about. When we look at PMI, we remember once you get to 20%, you can call your lender and say, hey, take my PMI off, unless you go with the FHA loan where you have to refi. And that's going to cost you probably $3,000 to $4,000. But if you're looking to just call your person and say, hey, I have a conventional loan, take it off my USDA loan, take it off. And once you hit the 20%, no problem. They take it off with like $300 or less.
Exactly. And sometimes you can basically...
So your payment will go down. That's what I mean. At the end of the day, the payment goes down. You're in a fixed house, fixed rate, and your payments start decreasing.
Exactly. And sometimes with the reevaluating the value of your property, like in a year or two, you might not even put that 20%. You can just ask the bank or any financial institution to appraise your house. And if this LTV or loan to value ratio is 20% or more, basically you
get rid of it, which makes your payment go down.
Yeah, the 80 actually is going to go down, and basically you get rid of your PMI.
Right, which means your monthly payment is less. Now, with the last thing, we're not going to tell you that you should buy a house, and just be house rich and cash poor. We're not saying that, but we are saying that if you assume that you are going to make more money in the future, which has always been an assumption, you're not going to be cash poor for long. So it's like a year or two or until you get that 20% down, and then you're knocking that out, and ultimately your home payment goes down. So we're not telling you to give up your life, but we are saying that a home gives you value that is going to help you with security, a place in the future, a place when you, because the hardest calls I get are people in their 80s and saying, we never bought a home, I now need to find a home, and because they're upping my rent. And you don't want to be that person when you turn 80. Like, I feel those are those are the calls I hate the most, because I don't know what to do.
Heartbreaking, basically.
Right. And I don't want that to happen to you if you're watching this video. So, because you've never bought a home. So it's better to have a home for when you can't afford it in the future.
Therefore, definitely it's going to give you the long-term shelter and stability. Financial instability definitely is important.
And then don't forget, if rates are high, don't forget your rates will come down, and if you refinance it, it goes back to 3 or 4%. That's amazing. You're in the driver's seat. That means your payments go down, but you're still in your house. So that's always what I want to say.
We don't have a crystal ball. We cannot tell you, but we can tell you that always you can refinance if the rates goes down.
Absolutely.
And thank you for watching this video and podcast. Don't forget to subscribe and call us at 252-327-3357 if you're home buyers or home sellers in the area or outside of the area. We love to talk to you, and see you in the next podcast and video.